Hello, today's March 5th. We want to talk about GameStop quickly. First, there's a lot expiring today in GameStop. Today's, again, Friday the 5th. 40% roughly of the Gamma position expires today. Now, most of that is puts. You can see the put to call ratio is 3 to 1. This is what the open interest is, 1.5 million versus 500,000. And volume yesterday was quite heavy in the put side relative to calls. Now, the market was very weak yesterday overall, but GameStop actually held up pretty good, right? It sort of pinned this 120 area, and then really the price is picking up, right? And what's interesting about that is that with 30% plus of the Gamma expiring, the picture is going to change next week. But what we've really noticed is that the biggest delta position doesn't expire until 3/19. So that's telling us that there's a lot of in the money positions that don't come due until 2 weeks from now. So there's a short term, what we think is put positions that are going to be removed here. And what's also interesting is if you note here, there's two colors. There's red, which indicates the name is in control of puts from an option perspective, and then green is calls. So if you were looking for a call gamma squeeze, you'd want to see the name cross into this green zone. Now, we would prefer to see this green zone darker, meaning there's a larger options position, but green still kind of tells you that the wind from an option perspective is likely at your back, meaning that there's fuel here or there's a little bit of spark for a gamma squeeze, another one of those gamma squeezes. And so 150 we see as resistance for today, and we think that these numbers all change into next week. And we want to see the position size. You can see the scale here get darker green, which tells us that the option position is bigger. But what's key to note, and we could just tell you this, is that the cost of call options has reduced quite a bit. If you looked at last week, the cost of a call option was, roughly twice that of what it is today, and that can likely be something that is fueling the stock higher. So if we flip over to this interactive brokers chart, you can see what we mean here. The implied volatility at the end of February was up here around 600%, right? Now that cost of options has come down quite a bit. It's still expensive. Don't get me wrong, but relative it has come down, but the stock has not come down in price. So if this implied volatility, if the cost of options can continue to come down, then the squeeze has a better chance of picking up because calls are cheaper. And market makers seem very quick to raise the cost of call options to make it expensive. That clips the leverage that traders get. If you think about it, if you buy a call option for just a few $100s, you're able to basically push a hedging obligation of several $1,000s on a market maker. So that's why we talk about leverage. So again, for today, we're thinking that the 150 area will be sort of a resistance point, but the big picture here is that this is a bullish move in Tesla, and if we can get sort of the call momentum started here, then the potential for an interesting squeeze play is in place. We hope that video was helpful. If you have any questions, hit us up at SpotGamma on Twitter, or please visit us at spotgamma.com.